So ETFs or mutual funds, that's a pretty prominent question that many people ask themselves when they first start investing. So what's the difference between the two and which one would be the better option? That's what we're going to be talking about in this video. Welcome back to the channel. If you're new here, then definitely consider subscribing and hitting the bell notification icon so that you don't miss any future investing and personal finance videos like this one. So for the past few decades, mutual funds have really been the king in terms of long-term diversified investments. But recently, exchange-traded funds, also known as ETFs, have really gained a great deal of popularity since the turn of the millennium. So let's first talk about the differences between the two, because they certainly do both have the pros and cons to them that you'll definitely want to be aware of before you invest your money anywhere. So ETFs and mutual funds, they can both contain the same exact financial assets within those specific vehicles. So you can have an ETF that holds the exact same assets as a mutual fund, but there's a few different factors that decide whether it's a mutual fund or if it's an ETF. So ETFs are constantly changing in price throughout the day as the different stocks and the bonds within the actual investment fluctuate every few minutes. But the price of mutual funds typically only varies on a daily basis. So one of the greatest differences between a mutual fund and an ETF is also going to be their legal structure of the investment. So let's take a look at how they differ and where they sort of compare. So in America, there are three primary legal structures on an ETF. And the first one is going to be an exchange-traded open-end index mutual fund, and it's pretty common to see this one, and what will typically happen is that the owner of the fund will reinvest dividends throughout the quarter as they go and then pay out those dividends in cash to their shareholders at the end of the quarter. And then we have something called exchange-traded unit investment trust, also known as UITs. And I don't want to get too technical here, but a UIT pays the interest income on the bonds and then holds a portfolio until a specific time when the bonds are actually sold and then given back to the investors. So this is great because a bond investor can own a diversified portfolio of bonds in a UIT rather than having to manage interest payments and bond redemptions on their own personal brokerage account. And so we also have something called Grantor Trust, and once again, I don't want to get too technical into this, but essentially it's pretty similar to a closed-ended fund, and you'll actually own the underlying shares within those companies, so you should have full voting rights and any other type of shareholder benefits as well. So those are the main three structures for ETFs. Now with mutual funds, we can have either open-ended or closed-ended funds, and you may already be aware of the difference between these two, so we're not going to jump too much into those, but essentially an open-ended fund, they can continue to release more shares to the public, whereas a closed-end fund, they can't do that. There are a couple of other differences between the two, but that's not something that we're going to cover in this video. So let's get into the expenses, which is probably going to be the part that you're going to care about the most. You know, which one's going to cost you the most in fees over the long run. So in general, the general consensus is that ETFs have a lower expense ratio than mutual funds, and that's after collecting data from thousands of different funds throughout the United States. We can really see that the expense ratio for ETFs is about 0.6% on average, and then for mutual funds, it's going to be about 0.73%. Now, there is a big bonus for ETFs, and that's they don't charge a load. That's probably going to save you a good deal of money because you typically will see a lot of mutual funds charging some type of load throughout the process. And so I would say that in general, ETFs are probably more friendly in terms of fees. You know, you might not save a ton of money with them, but it's probably going to be some money because you're probably not going to have loads on them. And in general, on average, they will have lower fees, but that's really going to be case by case. It's not like every ETF is going to be lower in terms of their expense ratio than a mutual fund. So you're going to have to take that case by case, look at each one before you actually invest into it, but that's just the general idea behind it. So as far as taxes go, ETFs typically will have more advantages than mutual funds, but the difference is not going to be astronomical, but there's definitely some reason to believe that certain ETFs could save you money on taxes as compared to mutual funds. But as always, this is going to be case by case as well. So hopefully I will remember to do this, but I'm going to try to link up a website that explains the tax advantages of ETFs, because if we go down the rabbit hole of taxes right now, we might never come back, and this would be like a 10-hour video. So I sort of like to think about ETFs sort of like a stock, because their prices are always fluctuating throughout the day, and you can typically get in and get out of them pretty quickly, and so you can even sell them short, for example, whereas mutual funds, on the other hand, are typically a little slower in the transaction process. You're not going to see people buying in and buying out of these funds on a frequent basis, and really you shouldn't see massive swings in trading volume within ETFs either, because I mean, most people are investing into them for the long term, but it is a lot easier to buy and sell exchange traded funds on a whim, basically. And some people even try to day trade some of these ETFs as well. So with all this being said, where do I stand on these funds and which one do I think would be the better option for somebody like myself? So I'm going to be honest with you, I have both mutual funds and ETFs, but I generally gravitate towards ETFs, as I probably just explained some of the pros of ETFs in this video. But I really can't stress this enough that it's really important to look at this on a case-by-case basis. So not all ETFs are going to be superior to mutual funds, but I think if someone was starting with, say, $200, an ETF might just be a more viable option since you can easily buy and sell it. There's generally no loads or no minimum amount that you'll need to invest into these funds. One more thing that I haven't yet mentioned in this video is that you'll likely want to consider the ability for an ETF to survive. So it seems like a lot of ETFs these days are really just popping up everywhere, and I think it's important to kind of just take a look at an ETF and say, like, is this actually going to be sustainable? Because I like to invest into Vanguard funds, for example, and Vanguard manages trillions and trillions of dollars. And so I know that their funds will be around probably 30, 40 years from now, and there's a good chance that those funds will be in existence. But sometimes you'll see some of these funds, and this can happen with mutual funds as well, but a lot of ETFs popping up out of nowhere, and you just sort of want to gauge whether it's going to be a sustainable fund. And so I think that's about it for this video. I think I made all the points that I needed to make here. ETFs, mutual funds, they're really not that different. They can hold the same exact assets, but ETFs generally, I will gravitate towards them just because of a few different things where you can save a little bit of money on taxes and whatnot. And so, you know what? That's it for this video, guys. Thanks so much for watching, and I'll see you next time.